All right, how's it going, guys? This is Weston Means here with eXp Realty here in the East Bay. I specialize in Oakland, Berkeley, Richmond, do a little business in San Jose, as well as San Francisco. And I'm here with my guy, Max Drew. How's it going, Max?
Hey, good. Good to see you.
And today we're going to talk about some strategies in real estate investing and how to use special deductions for investment properties to reduce your tax obligation. So we got a scenario set up for you guys. This is actually based on a real client scenario. We changed a few details, but pretty much the entire scenario is about the same.
Okay, yeah. Do you want to tell them about our websites before we get started?
Yeah, sure.
Okay.
So this is mine.
Weston Means Business.
WestonMeansBusiness.com.
That kind of sounds like you actually mean business.
It does, right? For some
Okay.
reason, it's strange, but that's really the message we're trying to get across. So.
Okay, well, I guess I'm playing out the card of being a big shot CPA, Magnum CPA.
Wow, is that you?
Yeah, that's me back before I did a little hair restoration. Hope it's like fine wine, improving with age.
That's right.
So I just want to show you this at magnumcpa.com. There is a website that's available now. This is just for your entertainment purposes. We do have a chatgpt.com, ask me anything.
Okay.
You can click on that link. You can ask any type of question there. We might actually try that later depending on how things go. 80% of the time it'll ask and answer exactly the way I would pretty much.
Oh, wow.
Because I've directed it on what websites to go out and do research that I would normally use to research questions for people.
Mm-hmm.
However, sometimes with new things such as Tesla car credits or things like the employee retention credit or things that are changing relatively quickly, it will tend to maybe not always have the most up-to-date information. But most of the time it does a pretty good job. But run all this advice through an actual financial professional or qualified CPA before you take it as gospel.
Got it.
Now, the other website, I know I'm kind of heavy on the promotional websites, Fit Advantages. So I'm starting to brand myself not just as a CPA, but actually as a coach. And the FIT stands for Finance, Insurance, and Tax. And the advantage is when you get everything working together. So there's a lot more to it there. We do get into a little bit of diet and exercise.
Wow.
It's more about coaching people to have a healthy, balanced life and be successful
in all aspects of life.
So now that we've got all that out of the way, okay, so the scenario is, so this could be a Jane Doe. What about Jane Doe is going on here?
So she owns a single-family home in Montclair. Yeah, so she owns a 5-bed, 3-bath home in the district in Oakland. So her home goes for about 1.6, depending on the updates. It's a 5-bed, 3-bath. Her main concern is that she's gonna have to be paying a lot in capital gains.
How much did she buy it for?
She bought it for about $500,000.
Wow. Okay.
Back in the day, a little while ago. No, she's single.
Okay, all right. Single. Yeah, wow. We could be looking at $1.1 million in capital gains.
Yeah.
Now, she might be able to qualify for an exclusion. Most of our people probably know this. It's a nationwide thing that the IRS has. In California, conforms. And California does the same thing as the Fed does. They say it conforms.
Yeah.
When it doesn't, it's non-conforming. And actually, California is one of those states which is very non-conformist for many things. But in this particular exclusion, we are conforming. So let's see, I think we're over here. Now, she lived in the house for more than 2 of the past 5 years?
Yeah, it's her primary residence. So she's been living there actually for a long time.
And she's single?
Well, she's divorced.
How long ago was she divorced?
More than 5 years ago.
Okay. Now, there's all kinds of exclusions, too, to like if you become sick and you're forced to sell the residence, if you have to move because of military things, where you might not make the 2 out of 5 years exclusion. And there's also selling because you're forced to sell for divorce and things. So sometimes all these little exceptions, it's worth talking to a CPA to see if you might qualify, even though on the surface you might not have made the 2 out of the past 5 years. So she'll qualify for a $250,000 exclusion from the gain on the sale. But jumping that spreadsheet over here basically means we're going to add $250,000 of tax-free gain, right?
Yeah.
So she would have $250,000 of tax-free gain.
Primary residence deduction for all y'all out there.
Yeah.
If you're single, you get to deduct $250,000 from your capital gains, and if you're married, it's $500,000. So it'd be double that. ML.
Okay, so the sale price for this example, so the taxable gain, that's going to be the selling price minus the basis which you paid for it, plus the tax-free gain exclusion, equal 850,000. That's a lot of income to come in a year. Now, luckily for the feds, they've done something where they call it capital gains rate. So they have a different tax rate for capital gains, which is, in this case, it's preferential currently, which means you actually get a lower tax rate than you would if it was regular taxable income.
And what's the tax rate on capital gains?
Let's go ahead and pull that up here. Okay, so long-term capital gains rate for a single, you could be looking at 20% for the amount that's 492,000 and over. So basically, she's got about, say she has 850,000 income, right? Basically over the 492 or whatever. Gonna be paying about 70,000 on that. For the first 400,000 more or less, she's gonna pay, or 500,000, she's gonna be about 75,000. So probably gonna pay about 140,000. So you do get a preference of.
Still feels like a lot though, to pay 140 grand in taxes in 1 year, even though you made a capital gain of 850,000.
Yeah, well, let's look at the regular tax rates, see what we'd be looking at here too.
Okay, that'd be an interesting comparison.
Yeah, give me just a second while I pull that up. Sorry for the delay here. All right, here we go. Fidelity, good old. So the tax brackets go up to about 37%, 35% up there. So you're gonna pay probably about 60% more, 70% more if you're paying regular taxes. So rather than paying 140, 150,000 to the feds, you'd be paying more like 250,000.
Wow.
So it is the capital gains tax rate tops off at 20%, where the normal tax brackets go to 37%.
Yeah.
So this one actually does not apply to the sale of a personal residence.
But it would apply to an investment property.
Well, it says that it's excluded from gross income. Only the taxable portion of the gain, including personal, is potentially subject to the net investment tax. So you might have an extra 1% tax on it too for the net investment tax. That's when you have lots of investment gains.
Mm-hmm.
So you do get a break on the first 250,000, but you might also be looking at the net investment tax. Now that one's a little bit more calculation to go into. It's actually 3.8% with that. And if you want to look up a little bit more about that, you might want to check out Investopedia. So see, actually, instead of 0.9%, what I was thinking of the Medicare tax, but it's actually up to 3.8%. So they've got all kinds of additional taxes that hit people who have very high incomes. So what we can do is we could do a tax projection. If you're thinking about selling your property, we actually put everything into the tax software, the scenario, and we try to project out what we think is going to happen. The tax software can usually do the income tax portion for us, but it's not something we necessarily want to just do on a napkin and piece of paper and think that it's gospel. Kind of falls into that 80% correct rate as opposed to 100%.
Yeah.
Usually we can do something like that for just a $100 consultation at my firm if somebody wants to run a scenario by us to see what kind of tax they're going to be hitting.
A scenario like this?
Yeah, something like that. We'll do like an hour for them.
Nice.
A lot of times we don't really make anything out of that, but sometimes people become our clients and eventually it can become like a good deal for everybody. But
right, you get to show your expertise a little bit.
And we are missional. Like our main thing is we're trying to help people.
That's
So
good.
if we help people, we feel good about it. We don't always kill it on every account, but on the ones that we do well on, it kind of makes up for the missional part of it too. Just we got to stay in business,
That's
that
good,
goes.
yeah.
So Dave Ramsey has the baby steps, and now I'm getting a little bit more advanced in my practice after a decade of working with Dave.
Yeah.
I'm coming up with my own brand of fit advantages.
Lovely.
Yeah, so we're flexible. We work with people, whatever philosophical background they're coming from.
Yeah.
But most people are trying to win in taxes and finance, which means they don't want to run out of money before they die, and hopefully they can build up enough of a nest egg that they can live comfortably while they're still here on planet Earth.
Exactly.
And then some people want to actually leave a legacy for their heirs.
Right.
Yeah, think about that. Wow. Now, something we also want to look at as far as taxes go and tax surprises. We talked about a couple of them, like the normal tax bracket versus the capital gains. That's a good surprise because capital gains is preferential. Bad surprise might be the net investment income tax, which is 3.9%. And like I said, we probably want to do a projection to see how that applies to you and if it applies. But the state taxes in California, actually, when we use the word capital gains, there's a capital gains tax rate. And that's for federal.
Okay.
California doesn't have a capital gains tax rate.
Oh.
Are we saying federal is preferential because it's actually lower than the normal tax rate? California is actually nice enough to just to give you the same tax rate that you're paying on all your regular income, and they don't give you any reduction. So for that, people are often surprised that their California taxes come back being much closer to their federal taxes than they're used to seeing it. It still tends to be about 40% less or whatnot, but we can look at the federal tax rates top out at like 20%,
Yeah.
and a lot of it's taxed at 15%, where you can see on that gain that's not excluded, that 15%. Now you could hit that 15% with your California tax rates are pretty close to it, so you might have like almost the same tax rate in California. Let's go ahead and get California tax rates up here. So you get 12% here, and you're like, okay, well, hey, the difference between that and the federal tax bracket, the capital gains, is only 15% or 20%. So very close to each other. Where normally you see the top tax bracket, normal tax is 37%, which it might be like 3 times the state tax.
Yeah.
So normally you're used to seeing a very large difference in the state and federal, but when it comes to capital gains, if most of your money is coming through capital gains, you can find that the tax brackets start becoming a lot. And a lot of times people are unpleasantly surprised at how much they're going to owe California. So that being said, we were kind of going to look at, that's good news, bad news type of thing. What were we wanting to look at? We're kind of focusing on, what's the focus today?
Yeah, so we didn't really get through the whole scenario. Basically, this woman owns a home in Montclair. Her plan is to sell the property and then buy 1 or 2 single-family homes in Pleasant Hill.
Okay.
And she has her own personal reasons for that, but essentially, she wants to move out of Oakland. She's lived there a really long time, and she wants to know how she can reduce her capital gains tax obligation as much as possible. And
Okay,
so
to buy 2 homes in Pleasant Hill.
Pleasant Hill.
Oh, I'll tell you what, on these homes in Pleasant Hill, what do you think they're going to be used for? Are they going to be more like business?
Yeah, so at least one of them will be an investment property.
Investment.
She'll rent it out, but she does need a place to live. So the idea was to maybe move into one of the homes. But I know that there are a lot more deductions when you hold homes as investments.
Right.
So,
hey, was this the one that you're talking about that her mother might need some help and she's thinking about maybe moving in with mom and
Right.
possibly having 2
yeah,
investment
exactly.
homes
Yeah.
versus
So
one?
mom is getting a bit older. Idea that she needs to maybe move in with the daughter, or the daughter can move in with her. So that's a whole other layer to this scenario, actually,
Oh,
as
right. That's right. I think what we were talking about on this one was what if she moved in with mom?
well. Yeah.
If this one might actually be better if she moves in with mom.
Okay.
Because mom's not going to live forever. She's got about 5 more years or so, I think you were saying. And mom needs some help. So she lives with mom. When mom passes, she might be eligible for a property tax. There's also property tax. California has a lot of taxes. The county usually taxes your property too. Tends to be about 1.1%. It just depends on where you're at, really. But around that amount. And they do have a thing now, it's an exclusion, where say your mom or dad bought the property for $200,000, but now it's worth $1.2 million.
Yeah.
So at $200,000, your property taxes are only going to be maybe $2,000 a year. But if the current price would be $1.2 million, then you'd have to be paying at least $12,000-$13,000 a year in property taxes.
That's kind of a lot. Yeah.
How can a person pay the same tax basis and county taxes as their family paid, the family member, mom or dad?
And in California, we have a law for this, and it's called
Prop 19. Yeah, Prop 19 actually replaces Prop 13. Prop 13 was great, for these like old empires where people just owned tons of real estate. All the real estate basis would pass on to the heirs. So you could have multiple properties, commercial, residential, all kinds of things.
Yeah.
And this empire would always stay at a very extremely low tax rate. So the generational wealth for real estate empires in California, they could just outcompete everybody, whether it was rental property, personal wealth building, or whatever, because they had a very low tax rate. So
Yeah.
$100 million in real estate, you're essentially going to be saving, hundreds of thousands every year in
Right. Property taxes.
So Prop 19, yeah. Prop 19 eliminates the parents' ability to leave to their children or the Prop 13 tax base, except with the personal residence. So the California Board of Equalization, who administers many different tax programs, including sales tax and property tax in California,
Yeah.
they have this publication about property tax transfers, so between parents and their children. On November 2020, so this is relatively new, California voters approved Prop 19, which is known as the Intergenerational Transfer Exclusion.
So how is it different from Prop 13?
Prop 13, you could do all the property your family owned.
Mm-hmm.
Now, Prop 19 says you can only leave the tax base to your next generation if they're actually living in the same house that you lived in. So example one, the parents purchased a family home in 1985. Factor base year value at the time of transfer was $300,000, while its current market value was $750,000. Since the current market value of the property is less than the factored base plus $1 million, so you can exclude up to $1 million. So if the property appreciates less than $1 million, they're not going to reassess the property tax base.
And if it appreciates by 1,000,001, what would happen then?
That'll be example two.
Okay.
Okay,
So
so
go into that.
So example one just says here the child would still be paying property taxes on the same $300,000.
And that's what they would have bought it for in 1985.
That's what the parents bought it for.
Yeah.
Example two, the parents purchased a family home in 1985 and it was worth $300,000, but it appreciated to $1.5 million.
Okay. So more than 1,000,000.
Yeah, so they lose the exclusion. Well, they don't lose the exclusion, but the exclusion doesn't negate the total amount of gain. So what they do is they get the $300,000, which was their base tax year that the parents have been paying on already, plus $1 million. So that's $1.3 million. So the difference between $1.3 million and $1.500,000 is $200,000.
Yeah.
So the property tax, the basis that becomes subject to tax, gets increased by $200,000.
Got it. So anything in excess of 1,000,000 worth of appreciation is going to be taxed.
Yeah, so since we are adding $200,000, in this case, the tax base, that property tax runs about 1%.
Yeah.
So we'll be adding $2,000 worth of property taxes every year. So if you're not from California, if you don't have property tax in the state where you're at, basically how it works is California pays a lot of their mostly school taxes, education taxes, through taxing the properties that people live in. So that's a tax that traditionally raises money for that. So wealthy neighborhoods are places with high values, or high home values, typically have a lot more money.
They have more school funding.
Education.
Right.
And
that's
if you live in a place with very low property values, you tend to have a lot less money to fund your schools.
right.
So
And it's very evident in lots of cities and counties and zip codes within California. You can see stark differences between neighborhoods with higher property values and neighborhoods with lower values. There's a lot of differences in just school funding, funding for different social programs and stuff like that. So
yeah, so if you think you might qualify for this, now here's the exclusion. It talks about the different conditions. There's a few conditions that apply here.
okay.
The family home must have been the principal residence of the transferor or the parent, for example. The transferee, the child, must live in the same home as their primary residence within 1 year of the transfer and must continue to occupy the family home.
So they have to be living there for a year before it can officially be transferred to them.
No,
the tax basis.
within a year.
Oh, okay. So
mom and dad die, within 1 year you have to move in. Yeah.
Okay.
The transferee, for example, the child must file the homeowners or disabled veterans exemption within 1 year of the transfer.
I see.
So you got 1 year to claim this exemption.
Awesome.
They also have another one for
Farms.
Family farm, yeah. So family farm goes into this. Okay, then it goes to who is eligible. A biological or a legally adopted child. I'm pretty sure that's what they mean.
Yeah.
Stepchild, in-law child, foster child in limited cases. And it can also be from child to parent.
Wow. And I don't think, was that the rule back with Prop 13 as well, or is that something new?
You got me on that. I need to go back and research it.
Yeah, I think Prop 13 was pretty much designed for parent to child transfer of tax basis, or just if the parents were moving somewhere, or maybe not even parents.
It was basically to keep the real estate empires happy in California.
And now we have this new law that is kind of like dethroned all that, huh?
I guess, now some of it might have been generous and passed off the low ability to own or operate those commercial properties to their tenants.
Yeah.
So maybe the tenants are seeing an increase in their rent, but some other people might have just been using the competitive advantage to keep more money in their pocket. Which, you can't blame people for, I guess,
Yeah.
It's the American way. We're still somewhat of a capitalist country. In
That's true.
other parts, California, it's getting debatable, but
Yeah.
I love capitalism.
Well, yeah.
I've lived in communist countries. I lived in China for a while.
Oh, you did? Yeah.
Yeah,
How long were you there?
About 5 years. And I know from the history there, under the communist regime, which became very woke and idealistic during their time,
Mm-hmm.
there ended up being about 50 million people starving to death because of extreme policies.
Jeez.
So I think it's not a bad idea to not get too extreme in our views.
Yeah.
But a little balance, I think I like California, we have a little bit more tax to pay.
Yeah.
But it goes to good cause, generally speaking.
I would agree with that. Yeah.
Yeah.
I'd say it's always about balance, not too extreme in either way.
So this is an example of the pendulum swinging towards maybe the up-and-coming people getting a little bit more chance, and the people who've kind of been
Who have had
benefiting.
generational wealth for many generations now.
taking a little bit of a hit.
Yeah. Yeah. So
Yeah.
it's kind of evening the playing field for a lot of folks out there a little bit.
Yeah, if life was constantly the same, it would be boring, right?
That's true.
Yeah.
Yeah. So this law, Prop 19, definitely shook things up. And it's giving a new opportunity for a lot of folks out there. So, I think that's a positive thing.
So, one thing they might consider is if they want to save a significant amount of money on taxes every year. In the example that you were talking about,
Yeah.
you'd be looking at about $11,000 a year in taxes because the original price was $500,000.
Yeah.
So if they gave this to their next generation, they could save yearly about $11,000 in taxes, right? So it could be an advantage, but in this case, since there's just mom who needs to be taken care of and we're not worried about intergenerational transfer from Jane Doe, then we'll go ahead and not worry so much about her getting that exclusion, but maybe considering moving in with mom and getting this exclusion on mom's property.
Right.
Because her mom owns her property, right?
Yeah.
Okay. And so one thing we talked about right now, there's something currently called accelerated depreciation, where normally you'll want to take a tax deduction for your property, and we'll kind of get into that a little bit later, but real estate's a very interesting in terms of investment.
Yeah.
It's a kind of a unique investment. Not totally unique, but it's got some qualities, some special qualities that attract a lot of investors. And I think we were going to take a look at...
and that would be namely depreciation.
Yeah, we're going to take a
the
look at the
asset.
depreciation, yeah.
And there's not really any other investments that you can depreciate like that, can you?
Well, business investments and stuff,
Yeah.
get depreciation for, but not personal assets, yeah. So normally, when you're doing residential property, most commercial properties, that means your buildings, your Safeways, your warehouses, things like that, you're going to depreciate over 39 years in a straight line depreciation. So that means you're taking about 2.5% depreciation on the building every year.
Per year for 39 years.
Yeah. And it's a little bit closer to 3% when you're looking at residential property. Yeah.
But to reiterate, this only applies if you hold the property as an investment.
Right. You don't get to depreciate your personal
If
property.
you're living in the property, no depreciation for you.
Yeah. Now, one good thing you can do is you can have a rental property, and maybe you want to sell it in a couple of years. So you've taken a depreciation from it when you've been renting it, so it lowers your taxes, and then you actually decide to move into that property and make it your primary residence for a couple of years, and then get either a $250,000 capital gains exclusion or a $500,000 capital gains exclusion. So there is a
Wow.
chance to get the best of both worlds, but
Yeah.
you had to lower the property basis by the depreciation that you took while you rented it out. So if you bought a $500,000 property and you took $100,000 worth of depreciation, then your basis would be reduced to 400,000,
Mm-hmm.
and then your exclusion would be 500,000 plus 400,000 would be 900,000 instead of the 500,000 plus the original 500,000 to be a million. So, you know, if that's kind of confusing for you and you're thinking about exploring that possibility, you know, maybe having a consultation, a more in-depth consultation to talk about that would work.
Yeah, we are. We're going into lots of different tips and tricks on taxes as they pertain to real estate as an investment.
So now, if you're only taking 3% of the property value every year, that's just, you know, say Jane Doe bought $1.6 million worth of real estate with the proceeds of the sale.
Mm-hmm.
And let's say 80% of that was equal to the cost of the building, attributed to the buildings, and the rest was attributed to the land. The IRS kind of lets you use this thing called the 80-20 rule. So a lot of times things get valued that way, even though it almost seems like the price sometimes could be the exact opposite.
Wow.
But anyway, tax law conventions and stuff, commonly we might see that happen on a tax return.
Mm-hmm.
So this would be the depreciable basis. Would be the part that's going towards building. In land, you don't get to depreciate. So land is going to equal, in this case, this minus this, 320,000. Now, let's
You
say,
can't depreciate land.
no, land doesn't depreciate. Luckily, though, it seems like there's a favorable way to kind of claim the building value versus the land value that the IRS tends to let us do. So if we're taking 3% a year on that 1,280,000,
Yeah.
you're going to get about $34,000 of depreciation, and that can offset
38,000.
Yeah, 38,400. Thank you.
Yeah.
That could offset your $850,000 gain by that amount. Now, what's interesting,
By
right?
38,000.
Only 38,000, right?
Okay.
So you're still going to have quite a bit of taxable gain. I think we were looking at 150,000 in tax at the capital gains rate, and then we were looking at the California tax. So it might have been about, you know, maybe 100,000 or so. Without doing the math, we can't be exact, so don't hold me to those figures if they're wildly different, but
Right.
it should be somewhat in the ballpark.
So that 38,000 is an estimate of what the actual depreciation based on the 27.5 rule that we talked about earlier would be for 1 year. Right.
Exactly.
It's approximately 3%.
And these figures aren't spot on because we're just using estimates and rounding, et cetera, et
Yeah.
cetera.
Yeah.
But nowadays they have a thing where it's called cost segregation,
Okay.
where the parts of the building that are going to last 27.5 years, they figure it's the foundation and the walls and the roof, basically.
Okay.
Those are longer lasting things.
Yeah.
But when it comes to fixtures, furniture, equipment, you know, carpeting, lamps, everything like that, you know, painting, all this type of stuff, a lot of these things can be expensed or depreciated more quickly than because they figure the lifespan of these items is less than the 27.5 years.
Mm.
They figure, you know, that sink that you put into the building
Okay.
might not last 27.5 years.
And how would you determine that?
You would go in, you could do a study of the building itself,
Mm-hmm.
and you could determine through an analysis, you know, perhaps with a contractor, perhaps with a qualified CPA, somebody who's got a little bit of training in this, or perhaps the architectural design person.
Yeah.
You could try to allocate the different elements, you know, what goes into the electrical system, what goes into the HVAC, what goes into the fixtures and equipment, things like that.
Mm-hmm.
And you could try to segregate those costs and actually expedite the expense a little bit faster. So in this case, maybe instead of taking 3% one year, maybe you're able to segregate, 30% of the cost to the current year, for example,
Okay.
which is basically you're saying besides the things that could be accelerated more quickly or segregated, maybe it ends up being somewhere in that ballpark, for example. Now you have to kind of get a professional opinion on this and get it broken down.
So I guess you'd have to get your own contractors to go out there, or is it?
There's specialists who specialize in this too, people who are qualified.
Okay.
So this is just a hypothetical example. Don't use these figures as actual.
Yeah.
Okay, and this is not a qualified, this is not a legal or tax opinion, but this is something that's happening now, which is allowed in the tax code, which is called accelerated depreciation.
Yeah.
And they call this, when you take a building and you break it down into what's can be expensed faster, they call it accelerated depreciation.
So just to say again what you just taught us right now, cost segregation is the process of finding these things within the home that aren't the roof, foundation, or the more permanent things.
Walls.
Yeah, and walls, and taking that out and essentially claiming that those things are going to depreciate faster than the other fixtures of the home. And then you use that to accelerate your depreciation, and you use the strategy of accelerated depreciation to take those things and add them to your actual depreciation for that year.
Yeah,
to
in a
reduce.
nutshell. So let's say, for example, in this particular case, she bought 2 commercial properties and wanted to do some accelerated depreciation.
Rental properties?
Yeah.
Yeah.
So she took the gain on the primary residence was 850,000 was taxable.
That's when she sold her home in Montclair.
Right. And then she bought two places for 1.6 million that she turned into rentals.
Okay.
Then we'll take the 384,000. The good thing about the 384,000, most of that's going to be taxed at the top part of the tax bracket, the 20%.
Mm-hmm.
So we're going to take, we're going to save, let's say,
So you're just like shaving the cream
on
off the
this, we're
top.
going to equal this. We're going to multiply it by maybe some possible tax savings. Let's say we've got 20% for the capital gains rate.
Okay.
And let's say we also might have 0.039 for the, if it is subject to the net investment tax, right? To be determined. I'm not saying that you will or won't be subject to that. We can do the analysis. And then let's say we got our friendly California tax. I think that was like at 12.7% or something like that.
I think it was like 12.3 maybe.
Okay, 0.123. Okay. Well,
Yeah, somewhere around there.
yeah, don't hold us to it. It might not be exactly this amount.
I think it was that.
But when you add that all up together, you're looking at about a 35% tax rate, for example, that you may be subject to.
Right.
So in this particular case, you might be saving about $140,000 in taxes. Now, I think we were estimating that you might be at around $250,000 in taxes.
Mm-hmm.
So that $140,000 that you save in taxes, that can actually, you could put those towards other investments, for example, if you're not having to pay tax on it.
Mm.
Another thing might be you might want to maximize your retirement, make sure your 401k is fully funded. So that could be another tax deduction that you can use with that cash flow, which would be an additional tax savings on top of that.
Lovely.
Do your IRAs, do this type of stuff.
Yeah.
Assuming that you have the cash available, or the means to get the cash available.
Right.
Because scenario A is you pay it all in tax. Scenario B is you try to find some workaround to save money on taxes. Yeah, and if you want to do a more complete scenario like tax breakdown, tax savings, and financial planning, then you can contact me, and if I'm qualified to help you, in your area and jurisdiction. Not that this is like an advertisement for areas, but I am licensed to do tax in all 50 states.
Wow.
Yeah,
Awesome.
with investments, it's more like on a case by state basis.
Got it.
So it's not it could be an advertisement for tax.
Yeah.
For investments, it would have to be case by case to see if I can help you.
Wow. And are most of your clients in California? Or?
Most of them are in California,
Okay.
Bay Area, south of Bay Area, and up to Northern California and Sacramento. We've got an office in Oakland and an office in Sacramento.
Nice. Where's your office in Oakland?
It's on Park Boulevard.
Oh, okay, nice. That's a nice area.
Home offices. So,
Not
we
bad.
used to have a slew of 4 or 5 office suites available to the public in Petaluma, California.
Mm-hmm.
But since the pandemic, we've gotten smart, like so many people have, and started working from home.
Oh, good job there, man.
Yeah, it's a easier commute to the office.
Uh-huh. Well, good for you. And thanks for taking us, running us through the scenario. That was Really good. We took the 850,000 of capital gains and we reduced it to.
You could offset the capital gains by the accelerated
Yeah, we didn't
depreciation.
actually reduce the capital gains, but we took these other deductions.
So we could say that. We could call it an offset if you wanted to.
Yeah.
If that's the correct word, or offset by accelerated depreciation.
Mm-hmm.
The accelerated depreciation we're thinking about in this particular example might be 384,000.
Yeah.
Now, one thing you should know, if you do residential real estate, there's going to be you're going to expect to get less accelerated depreciation than if you do commercial real estate. Commercial real estate, you can generally be able to find a lot more there. As a rule of thumb. Now you have to actually get a study done on whatever property you're looking at, and make sure you have a qualified person do that. So, but in general, if you were really looking to offset more by a purchase, usually a commercial one's going to yield you more
Deductions.
accelerated depreciation that you can take the first year.
Got it.
Yeah. So.
That's awesome. So we took the 850,000, took an offset due to accelerated depreciation of 384,000, and the new. Wait, are those taxed at the same rate actually?
Well, see, the first 400 and the first 500,000 is taxed at the 15% tax rate.
Okay.
Right here.
Yeah.
So the nice thing is when you get rid of the 384,000 off the top,
Yeah.
and then you bring the taxable capital gains down to 466,000,
Ah.
most of that's going to be taxed at the 15%
15.
tax rate.
Right.
And the 384, which would be taxed at the 20% tax rate, additional, more or less, not perfect, but relatively is good. So you're saving from the higher tax bracket.
Right. So 350K of that 850 would have been taxed at 20%.
Right.
Or approximately.
Approximately.
It's 492, which is a weird number. But.
Yeah, approximately.
Okay.
Approximately. Yeah.
And I think we had one more article to go into, and this actually talks about cost segregation, I think.
Yeah, which is kind of what we were talking about here, what I call with the accelerated depreciation.
Mm-hmm.
Cost segregation is study of the building and figuring out what systems could be separately identified from the building and possibly depreciated faster.
Mm-hmm.
And then the accelerated depreciation is
The act of taking those things and
speeding up and taking it in 1 year rather than multiple years. I don't recommend you do that without a qualified tax professional and expert in that helping you.
Mm-hmm. Oh, and real quick, Max, just for the viewers, I know you used to work for the IRS, didn't you?
No, I worked for the state of California.
Oh.
For the Board of Equalization.
I see.
And I used to be a collections agent for the state of California.
So you're collecting the California tax.
Yeah, so if you want to get those exclusions and things like with Prop 19 and stuff, I was back in the Prop 13 days, but it's kind of like I kind of know the system of working through that, going through the paperwork, et cetera, et cetera. So if you're in trouble with either owing taxes or trying to get an exclusion, that's something you might want me to help you out with. Also, the California tends to kind of follow some of the same procedures and ideas as the IRS does.
Mm-hmm.
Not exactly, but similar enough that if you're well versed in IRS or state of California, you can help with the other stuff too. So
yeah, I remember. I think I read your website, and there was something on there about you being on the other side of, because now you're a tax preparer, but you used to be the tax collector.
Yeah,
so that
the
was
tax preparer. Sometimes people are upset because they owe taxes, and other times people are happy because they're getting a refund. When I was a tax collector, it was always bad news.
Right. Yeah, you're kind of like the bad guy there.
Nowadays, we do a lot of tax planning now, so that tends to head off the nasty surprises for people.
Anyway, I thought that was kind of a selling point, just knowing that you had seen it from the other side, and now you're the guy who's kind of like submitting to,
help people out. Yeah, I'm definitely qualified for that. I'm trying to get more into helping people be on top of their taxes and not get in trouble. But oftentimes the new clients who get referred to me or who come to me might be in a jam. So they're like, oh, I think I need a CPA because I have this problem. So sometimes it's a big deal.
So you're like a guy that puts out fires now.
Yeah.
Almost like a real estate agent.
Yeah, sometimes the new clients have really huge things that we need to handle.
Yeah.
And then once we get them on track,
All right, well, let's dive into this article really quick. So this lady is a real estate investor, and she has a 311 unit portfolio of rental properties. She breaks down the tax rule that saved her hundreds of thousands of dollars last year. And she also got a check from the IRS for $167K.
Now, one thing that's kind of interesting, remember how we were talking about how it can save you from that capital gains rates?
Yeah.
Now, if you manage the real estate yourself and you qualify as a real estate professional,
Mm-hmm.
or if you are the primary manager of your own property, like you collect the rents, you do manage the repairs, you kind of work with the tenants, et cetera,
Yeah.
you can actually take an active deduction on these expenses that we're talking about. So for the person who's maybe working at Google and has that $500,000 a year salary,
Mm-hmm.
and maybe they have a parent pass away and they have a windfall of $1 million,
Mm-hmm.
they could actually offset some of their current year taxes by purchasing a big investment property and having a big accelerated depreciation will actually offset their salary income, for example.
Wow.
So not only can it hit that 20% or 15% tax rates,
Yeah.
it can also go against your salary tax rates if you're actively managing the property. So if
Oh.
you get
So you have to be your own property manager for this to work.
generally speaking, yeah, or be a real estate professional.
Okay. So I would
Yeah.
qualify for this
Yeah, but
strategy.
a surprising amount of people can qualify for it, but you're going to want to talk to a qualified CPA and go through like the rules test to make sure that you meet the rules to qualify before you take it for granted that you can do that.
Okay.
Yeah, but
That's good to know.
so let's say you're at the 37% tax bracket because you're killing it with that, and you're getting the 3.9% tax on top of it, the net investment income tax,
Mm-hmm.
and then you're also getting the 12.7% California tax. Okay, well, pretty soon you're like at 50% tax
It's
almost.
a lot of taxes.
Yeah, 40,
Yeah.
50%, yeah.
Mm-hmm.
Now, the only people who pay more than that are probably like the self-employed people. They also have the self-employment tax. Yeah, they get an extra 15.3% tax.
All right.
Goes towards your Social Security and Medicare. But a lot of times, self-employed people, they aren't expecting an extra 15% tax at the end of their first year. And, planning for that is a big deal.
Yeah.
So you could be at 50% tax rate easily in California between self-employed tax, California tax rate, and federal tax rate.
That's very true.
So you do accelerated depreciation. If you're going to find a way to take $500,000 worth of accelerated depreciation,
Mm-hmm.
that could be worth $250,000 in less taxes, for example.
Mm. I just had an idea that maybe on our next meeting we can talk about forming S corporations or other entities that you can pass your income through, because that's what I did to kind of like offset some of my taxable
The
income.
employment taxes, yeah.
Yeah.
That might not be a bad topic. Now, one thing we did want to go back to, which I think might be a good way to round out what we're talking about,
Yeah.
is the unique quality of investing in real estate, which is, for tax purposes, when you invest in a normal thing, like let's say you buy a stock, right? I bought a stock for $1 million. I bought $1 million at Google or Amazon, hypothetically.
Okay.
And that $1 million, while I'm holding it, I don't get any tax deductions on it. And when I sell it, if it goes down or it goes up, I'll pay capital gains on it if I've held it for more than 1 year and 1 day. Or just remember it has to be 1 year and 1 day.
Oh wow. Just like a lot of things in the tax code, but it's very specific.
Very technical. So you bought $1 million Google stock, $1 million. Now you buy real estate, and let's say you're going to allocate $800,000 to building and $200,000 to let's say land. Okay. Meanwhile, let's say you're taking about 3% every year. You're taking $24,000 in deduction every year. That's assuming you rent this out as commercial real estate, residential, right? The good thing about real estate is even though you're taking a deduction every year on it, like expenses that you can offset your taxable income by,
Mm-hmm.
we know that typically speaking, just like Google stock would be, you'd expect your real estate value to actually be increasing over time.
Appreciating.
An asset that's appreciating in value, it's growing in value, it's an investment,
But you can depreciate it.
but you're actually expensing it like it's something that's losing value. So the unique thing about real estate is it's a depreciating asset for taxes.
But it actually appreciates in value over time.
The thing about real estate could be is sometimes there's something we call selection risk.
Mm-hmm.
The risk that you purchase something in an area that for whatever reason the housing prices go down. Now we haven't really seen that too much in California, but
Not for a while.
I've heard stories about places like Flint, Michigan, and different places like that where there may have been houses that eventually became unsaleable, things like that.
Yeah.
Where they were
Dilapidated.
in a traditionally hot property market and good property market. So there's always some sort of risk. So usually diversifying into multiple assets It's just the whole strategy of not putting all your eggs in one basket.
Yeah, I think that's always a good strategy.
But sometimes when you buy something in California, you almost feel like you're forced to put all your eggs in one basket because of the prices here, right?
That's true.
Yeah.
For a lot of folks out there, actually is the reality.
I think you should try to vet your long-term strategy to see if in a temporary, if maybe you're doing that, but just maybe your long-term goal could be hopefully that you'll see a way to be more diversified in the long term, even if you got to like bite the bullet in the short term and be more concentrated in order to get into property here in California.
Yeah, well, that's what it takes for the most part in a lot of areas, especially in the Bay Area. We live in one of the highest cost areas in the world. And so even folks on a Google salary, a lot of times will have to put, most of their resources towards a home purchase just to get in that first home and start building equity. So, like Max said, you may have to focus in on real estate for the first part of the race, but then as time goes on, that asset will appreciate, you'll continue to make money, and you should be able to diversify your investments in the future. So, and this is the guy who can help you with looking into all those different types of investments.
Yeah, but you can help with something else too, right?
I can help with the real estate side.
What market do you deal with mainly?
Mostly East Bay. I was born in Berkeley, so I do business in Berkeley, Albany. I also went to Cal State East Bay in Hayward, so I do business there. I do a little bit of business in San Francisco. And I also lived in Marin County for about 5 years, so I'm very familiar with that market as well.
So are you licensed to do business just in
All of California, yeah.
Okay.
Yeah.
Any other states?
I actually just got licensed in Arizona as well. So for the folks that are moving from California to Arizona, and I actually saw quite a bit of that in 2020 and 2021 when the rates were super low. A lot of folks, because we moved to remote work, and so a lot of tech folks, especially from the Bay Area, didn't have to be in the office anymore. There was the pandemic. And so I saw a lot of folks moving to Texas or Arizona. And now I have my Arizona license, so I can definitely help with either going for a move out there because the cost of living is so much lower, or just buying investment properties, rental properties that will probably appreciate over time as well. I mean, if you look at the history of the real estate market, it's always gone up over time, no matter what.
Yeah, you can.
Even if there's dips in the market, it's over time it's going to go up.
Well, back when I was born, back in the 70s or whatever,
Okay.
prices were actually quite a bit more lower than they are now, believe it or not.
Really?
So that would kind of make sense that prices are appreciating over time.
That's incredible.
Now, I think in 2008 you could have got a deal.
That's true.
There was a time, a brief window, a market, but that's when that was when the mortgage lending rate practices or lending practices were out of control. They just kept letting you.
Yeah. They were giving out loans like candy.
They would let you do it on the hypothetical value of your home. You could refinance and get an equity line of credit.
Right.
Where they pretty much got rid of that problem.
They have.
Yeah, so now they only loan you on your ability to actually bring in cash. It's more like cash is king now.
Yeah. The qualifying process for lenders with their borrowers is a lot more stringent now. So they're really looking into how much income you're bringing in, and they're pretty much triple, quadruple checking that you can really afford the home you're purchasing.
So, that brings me to my next thing, probably the last thing.
Yeah.
I did expect housing prices to go down, especially for the cash buyer, once the interest rates started going up.
Mm-hmm.
And surprisingly, I don't think we've really seen a dip in housing prices in California.
No.
And for me, I was kind of bit by that. I was trying to time the market. So I guess,
that's always a losing strategy. I think
it's a losing strategy, timing the market.
Yeah.
I thought for sure that was going to happen. The law of economics would dictate.
Well, the problem is there's so many factors that go into economics. I mean, it's like there's like wars going on. There's all these different forces that play on it. And like there was a pandemic that just happened recently. And so timing the market is always a losing strategy because a lot of folks will have predictions about what's going to happen. Like when COVID came, a lot of people were like, oh, the market's going to crash any minute now. And 2020 happened. Guess what? I think the Bay Area appreciated about like an average of about 20%. And then in 2021, we had something similar. 2022, again, something similar. People thought the market would crash in 2020, 2021, 2022. And now 2023, we actually, even though rates have increased significantly, we've still seen an average increase in the Bay Area of about 4 or 5%.
Even though people are leaving the Bay Area, even
Despite
though rates
all
have
that.
increased, even though tech layoffs, come what may, one thing's for sure, the price of goods are increasing. The overall over any given period of time, you're always going to see housing prices going up, and for the history of the S&P too, you're just always going to keep seeing an increase in that kind of thing over any significant amount of time. So
Yeah.
it's tough to time it. If only I had a crystal ball, I wouldn't be working. I would just be like moving my money
Yeah.
around from place to place.
Yeah.
But even knowing everything I know, I have to say, I'm still working, unfortunately.
Yeah, there's all these memes online about like, oh man, there's a picture of me in 1992 when I was born. It's like a baby photo, and it's like, oh, I was messing around being a baby, and I should have been buying land in California or something.
You should have been working back then.
I know I should have been buying real estate.
Lazy toddler.
I'd be like a multi-millionaire by now.
Well, that's okay. Don't beat yourself up too bad. A lot of other babies aren't working either, so it's a big unemployment problem with that.
Yeah. Anyway, this was a really good time. Thanks for coming, Max.
Thank you for having me,
It's been
Weston.
really good to see you. Thanks for taking us through these examples. You definitely showed us your tax prowess.
Yeah, this is my first kickoff with the new company branding, Fit Advantage, into the social media category. So I couldn't
He's
have.
becoming an influencer now.
Yeah, I'll try to keep up with the good people like yourself.
Awesome, man. Well, this
Yeah.
was a good session. I really appreciate your time.
Thanks a lot, everybody. We'll catch you in the next one.
See you guys.